Welcome back. This is part 5 in my 5-part series on financial advisors. If you haven't checked out the past episodes in the series, please do so. And last week we discussed what to expect when you're hiring a fee-only advisor. And this week we're discussing how to ensure that your financial advisor partnership is delivering value to you over time. And this could be if you've just hired your first fee-only financial advisor recently or financial advisor, or if you've been working with an advisor for some time. And I'm doing this series on financial advisors to celebrate the release of my first book called Fiduciary: How to Find, Hire, and Establish an Aligned and Trusted Partnership with a Fee-Only Financial Advisor. And you can learn more about the book by going to retirewithryan.com/book. When you think about receiving value from working with a financial advisor, your first thought probably jumps to whether or not you're seeing financial gain in your investments. And this is definitely a critical component of your relationship with a financial advisor. And I'll discuss throughout this episode how to evaluate that at length. But there are other elements that contribute to the value of this partnership as well. And I've identified 4 key areas your advisor should be delivering value to you with your financial plan and your financial life. So these areas are awareness and disclosure of fees, performance of your investment portfolio, financial planning benefits, and communication. And throughout this episode, I'm going to go over each of these so that you'll be equipped to assess the performance of your advisor within these 4 primary areas and make sure that you're getting the most out of your fiduciary partnership. And if you're able to then place a check mark next to all of these areas in some questions that I'll ask, then you'll know your partnership is serving you well. And if you head over to retirewithryan.com/podcast/205, because this is episode 205, then you can download a helpful checklist with this information so that you could go through this with your existing advisor to make sure you're getting this value. And if you find any areas lacking, you'll know where to place your focus in either improving your performance and relationship with that advisor, or maybe reevaluating whether or not this partnership remains in your best interest. So let's start with awareness and disclosure of fees. Now this sounds simple, but do you know what you're paying your advisor on an annual basis for their services? Do you know the ongoing costs of the investments you have in your portfolio? I can tell you from sitting down with over 1,000 people that have attended my retirement readiness workshops and reviewing their portfolios, most people do not know the answers to these questions. These are important answers to know, as paying too high a fee for your advisor and for your portfolio can have a majorly detrimental impact on the long-term growth of your assets and the long-term success of your financial plan. If you're working with an advisor, they should easily be able to provide you with this information as far as what you're paying them. Your advisory fee, in my opinion, should be 1.5% per year or less. This is based on the size of your portfolio, and if it's $1 million portfolio or more, that fee should be closer to 1%. The larger your portfolio grows, the lower that this annual fee as a percentage should be. That's standard for the industry and most firms. And if you're paying 2% per year or more, you're paying way too much, and you should find another advisor. And as I've mentioned, our fee starts out at 1.25% per year for clients with portfolios of less than $1 million. And then our fee declines to 1% for a client with $1 million or more. It further declines to 0.85% for clients that have portfolios of $2 million or greater. So this is common, as I said before, for the financial planning industry. And our fee is on the lower end of the industry. It's certainly not the lowest, but I like it to be a reasonable cost. So if your advisor says you're paying them nothing, which some will tell their clients, they're obviously lying, right? How are they going to be in business if you're paying them nothing? And unfortunately, I've heard this countless times from people that have met with non-fiduciary advisors who sell usually high-cost products like annuities, mutual funds that have high costs built into them and compensate the advisor through the costs that are in these products. However, you don't see this fee coming out of your investments because it's being taken out kind of not without your knowledge, but without you seeing it. However, if you read the fine print in the prospectus for these products, you'll see that it's in there. Believe me, I've read many prospectuses for annuities and have disclosed and found these fees for people, letting them know what they're paying and how they can save money by changing from these products. A fiduciary advisor will clearly disclose to you what you're paying them, and it will also show up on your statements as a management fee. Most firms are collecting this management fee on a quarterly basis. However, some are doing it monthly. And if you look carefully at your statements, you will find it, and it shouldn't be hidden. The next cost to be aware of is the annual cost for your investments. If your advisor is investing your money into mutual funds or exchange-traded funds or ETFs, as they're more commonly known, there is an annual cost for these funds. And as your fiduciary, your advisor should be keeping an eye on these costs. That's part of their fiduciary obligation. I would like to see those costs for those funds, if you average the cost of all of those mutual funds or ETFs that you're in, be less than 0.30% per year. And you can find many great funds that will fall into this range of a 0.30% cost per year. You can also find a lot of funds that are much less than that. But depending on your advisor's strategy, it could make sense to have some more actively managed funds that could cost a little bit more. So I cover investments in greater detail in my book if you want to check it out to learn more about that. But if you're paying 1% per more a year of annual costs in your mutual funds or ETFs, which I know many people are doing because I've seen it from reviewing client portfolios, you're paying way too much. You definitely need to talk to your advisor and see if there's something you can do about this. And as I said, I see this all the time. These are with companies that are very well known. I don't want to mention their names because I don't want to be, sued. But you see their commercials on TV. You're familiar with these companies. Many of these firms are not objectively looking at the funds they invest their clients' portfolios into. And I feel they're failing at their fiduciary duty. And why are they not looking at these funds objectively? It's because they're getting paid by these funds to invest their clients' money into these higher cost funds rather than putting them into lower cost funds. And this is called shelf space or pay to play. Unfortunately, it's perfectly legal, and it's disclosed by these firms that do this, these large brokerage and investments firms, and it's one of Wall Street's dirty little secrets. Just type in mutual fund shelf space into Google, and you'll find many articles about this. However, many consumers have no idea it's happening to them, and this is why it's important that you know all the fees you're paying in your portfolio, not just the advisory fee. Some firms will have a lower advisory fee, but will have a much higher mutual fund fee. So you might think you're paying less than another advisor, but you're actually paying more in all-in costs. So if you work with a fee-only advisor, you're less likely to be put into these high-cost funds, or if you work with an advisor who doesn't work with one of these household names, they are much more in control of what they're doing with their clients' money, and most of these firms, like my own, don't participate in anything like this shelf space or pay-to-play program. So if you can answer yes to the following two statements, then you can check off awareness of costs and fees in your performance evaluation assessment. So the first is the fee arrangement with my advisor is straightforward, and the fees I am paying are clearly shown on a quarterly invoice or on my statements. And the fees I'm paying in my investment portfolio for your mutual funds or ETFs are known by me and have an average annual cost of less than 0.30% per year. And again, if you want to get this checklist, head over to retirewithryan.com/podcast/205 to download this checklist. So as I said in the beginning of this episode, how well your investments perform are not the only factor you should consider in evaluating your fiduciary partnership, but it's definitely a significant one. And if you discover you're paying unnecessary fees or your performance is much worse off than if you were with no advisor at all due to bad management, it might be a sign to leave the partnership. However, it's equally important to understand what reasonable investment performance may look like over time. And while no financial advisor can guarantee you how well your investments will perform, markets consistently fluctuate, and you, however, should have a good idea of how well your portfolio is doing for you. To that end, we're going to examine some of the facets of evaluating your investment portfolio so that you're aware of all the aspects to consider. So you first have to understand what you can control and what you can't control. So I can't overemphasize the importance of recognizing what you as an investor can control and what you cannot. So you cannot control market conditions, neither can your advisor, meaning you can't control if the market's going to go up and down in any given year or any given month, right? Your advisor can make predictions, do their best to guess, but nobody knows the future. However, you can control how you and your advisor invest your money, right? You can control what investment products you go into. You can control your asset allocation strategy. I've talked about that at length over, the different episodes I've had on investing, but simply what that means is how much risk are you taking on in your portfolio? How much do you have in stocks versus bonds versus cash? Again, I talk about this more in depth in the book if you want to check that out. And you can control your reaction to market volatility. So you can control how you react to the markets, right? You have to understand yourself and understand what your comfort level is for risk. So if you work with your advisor and you guys work well together, you should be able to develop a portfolio that's one that you can stick with. And your advisor can do a great job of developing your portfolio, but you as the client must be truthful with your advisor as you're developing your portfolio to know what you can and can't tolerate. If you're someone who is really frustrated by market fluctuations and it just drives you nuts to see your portfolio down, then you probably need a lower risk portfolio, even though maybe you probably need a higher risk portfolio, but you're not going to be able to stick with that portfolio because you don't want to make hasty decisions at the wrong time. And so this requires a solid understanding of yourself, your natural reaction to risk, and whether you have a tendency to flee or want to bail out of your portfolio when things get tough. You certainly don't want to sell your portfolio at the bottom of the market, right? You don't want to do the opposite. The goal in investing is to buy low, sell high. You don't want to buy high and sell low. And believe me, people do that all the time because they chase performance and they don't build a portfolio that's based upon what their goals are and what they're going to be able to stick with. So, does your advisor have a target asset allocation? Does your advisor have rebalancing strategy? Meaning, how are they keeping your portfolio in line? Like when stocks do really well and now maybe your portfolio is more aggressive, are they selling some stocks and buying some bonds and vice versa? And how are you monitoring the performance of your portfolio? Is this information accessible to you? Obviously, any company you deal with is going to give you statements or send you statements, but a lot of those companies don't provide performance reporting because over time, as time goes on and you add money to your accounts, you take money out of your accounts, it becomes more difficult to understand what your performance has been. So because of that, your advisor should be utilizing some type of performance reporting software so that you can see how you're doing over time. Whether they provide you quarterly performance reports, as some firms do like my own, or they offer you access to an online performance reporting software where you can go in there and you can generate those reports yourself, or you can look at just your portfolio over different periods of time. It's important that you can do that. So it's also a good idea to have the ability to compare the performance of your portfolio to a benchmark. So what is a benchmark? It's a way to measure performance of a certain segment of the financial markets. Say, for example, your portfolio is 100% invested in U.S. stocks, then an appropriate benchmark would be the S&P 500. That's a benchmark of the largest stocks in the United States. So if over time your portfolio earned more than the S&P 500, then you did very well. But if it earned a lot less than just the simple S&P 500, that's not good. And that's where you would start to really have to evaluate whether or not your portfolio was properly invested. And as you start to shift more bonds and cash into your portfolio, you need to adjust your benchmark because let's say you were invested 50% in stocks and 50% in bonds. You wouldn't want to compare your portfolio to the 100% to the S&P 500 because that is not an appropriate benchmark. You'd want to adjust your benchmark to incorporate bonds into it so that you're comparing it to the right thing on a relative basis. So it's important that your benchmark is appropriate based on the portfolio that you have. And your advisor can easily allow you to access that. So if you can answer yes to the following 5 statements, you can check off performance of investment portfolio in your performance evaluation assessment. So first, I'm aware of what I can control and what I cannot control and make sound decisions accordingly. I have a clear rebalancing strategy in place with my advisor, and he or she monitors it quarterly. The return on my investments I'm receiving is in line with the appropriate benchmarks. The benchmarks I'm using are the correct ratios based on the right percentages of my portfolio based upon how it's invested. Again, the right mix between stocks, bonds, and cash. And lastly, I have a clear way of assessing the gains versus my benchmark, either through quarterly statements, an accessible website, or report generated by my advisor's software that shows appropriate comparisons. So the third area can be challenging to measure, but if your advisor is assisting you with your financial planning, that whether it be retirement planning, insurance, taxes, tax planning, estate planning, you want to feel confident you're receiving value from this guidance. And I explore this again in greater depth in my book, but as a quick summary, do you have a financial plan that's aligned with your retirement goals? And is that plan being realized or moved forward? Is your advisor helping you with reviewing your insurance policies, whether it be life insurance, long-term care insurance, health insurance, disability insurance, to make sure you have the right coverage? Does your advisor go over your taxes with you on an annual basis to help you do tax planning to see where there are opportunities to maybe defer taxes or potentially pay less taxes into the future? Has your advisor helped you to review your estate plan to develop a plan so that just the basic elements are covered, your wishes are in place, and the settlement of your estate will be simplified for your loved ones? And has your advisor followed through with the delivery of your financial plan? Does your advisor update your financial plan on an annual basis? Unfortunately, in this area, talk is cheap, and almost every financial advisor out there today claims to provide financial planning as part of their services to their clients. However, I often find many advisors never follow through on delivering this plan. I'll have clients tell me they have a financial plan. I'll ask to see it. They don't have it. This advice is really just more investment related. Investment and management advice is definitely important, but that's not financial planning. Financial planning addresses these other key areas. So if you can answer yes to the following 4 statements, you can check off financial planning benefits in your performance evaluation assessment. 1, you have a written financial plan. 2, your advisor goes over your financial plan annually and updates it with any changes in your life. 3, your financial plan is comprehensive, including retirement planning, investment planning, tax planning, insurance planning, and if necessary, stock option planning, college planning. There can be small business planning. There can be other areas that are pertinent as well. And lastly, with this section, your advisor involves other professionals when necessary to help you with your financial plan, such as attorneys, insurance agents, or accountants. So the final area in evaluating the relationship with your advisor is in evaluating the communication that you and your advisor have. So some questions to ask yourself are, do you hear from your advisor at least once a year to find out if there's been any major changes in your life that would warrant taking a deeper dive into your financial plan or your portfolio? How does your advisor stay in contact with you? Do they send emails, phone calls? Do you have Zoom meetings, in-person meetings? And whatever this method is it working for you? And is it what you feel you're getting the most out of? If you reach out to your advisor with updates or questions, does your advisor make time to discuss your needs? And do they follow up with any requests or concerns you might have in a timely manner? Is your advisor coordinating with other advisors, as I mentioned earlier? If applicable, are they coordinating with your accountant, attorney, insurance agent to make sure they're working as a team for you and you're not missing any opportunities? When you meet with your advisor to review your portfolio, do they make you feel comfortable with the portfolio? Do they review spending habits, future cash flow needs to figure out what makes the most sense as far as where to draw that money from your portfolio? And do they make proactive adjustments to the portfolio based on life changes or revised goals, such as, is your portfolio being adjusted over time as you get closer to retirement maybe? So if these elements are present in your communication with your advisor, you should feel good in this area of your partnership. And if any area is lacking, it may simply involve bringing this concern to your advisor's attention, right? So if you can check off yes to the answers, the questions that I asked earlier, then you should feel confident that you're getting the right communication or you have a good communication with your advisor. If you've given your advisor an opportunity to improve upon something that's lacking and they're not, living up to that expectation or failing to, improve that, then maybe it's a sign that you need to seek a financial advisor. So again, there's a lot to consider when working with a financial advisor. If you've been working with them for a long time, performance is certainly an important part of that, but also the other areas that we've covered. And again, consider downloading this checklist. If you want help evaluating this performance, go to retirewithryan.com/podcast/episode 205. And I hope this series on financial advisors has been helpful. I've really enjoyed discussing it. Much of what I've discussed comes from the book that I've written. So if you haven't purchased a copy and you're interested in doing so, you can also do that by going to retirewithryan.com and clicking on book. So again, I hope the financial advisor you're working with is delivering value to you. If they're not, see if there's improvements they can make to put things in place so that you're actually getting the value that you should. And if they're either incapable of doing that or you feel they can't, then it's time to reach out to another fee-only financial advisor. We currently are taking on clients, so if you can always reach out to us and find out if we're the right fit for you, or you can follow the steps laid out in the book to reach out to another fee-only financial advisor. Because I believe your money and your future are too important to accept either poor investment performance, poor service, or poor advice. So have a great week, and I look forward to talking with you next Wednesday. Take care.